with more details.
Many thanks. That concludes question time, and we now turn to the next item of business. I'll allow a few seconds for ministers and front bench members to change seats. And the next item of business is a debate on motion number 8610 in the name of Fergus Ewing on the Bankruptcy-and-Debt-Advice Scotland Bill. Can I invite members who wish to participate in this debate to press their request to speak buttons now, please, and also for members to check that their cards are in their terminals. And I call on Fergus Ewing to speak to and move the motion. Minister, you have 14 minutes, and after which I will be calling Murdo Fraser on behalf of the committee.
Thank you, Presiding Officer. I'd like to start by thanking Murdo Fraser and the members of the committee and the clerks involved in producing what I think has been a very sensible, considered and helpful report at stage one. This bill will address one of the most serious problems facing Scotland in the 21st century, which is debt, specifically unmanageable debt, which can give rise to bankruptcy. I'm pleased to say that the Government has been active on this important issue in a number of respects. First of all, we started out with a vision developed by the Accountant in Bankruptcy for what we call a financial health service for Scotland. And over the course of this year, we have been building on that vision and have translated it into the bill before us today. Secondly, this year we have acted on payday loans, and with others we have pressed home our campaign to have the UK Government place a cap on the interest rates charged for payday loans. Just last week I welcomed the FCA's decision finally to impose this much-needed cap. Of course, as we debated last week, Presiding Officer, the Scottish Government do believe that it could and should happen sooner than 2015. We argued that it should occur in April next year, and we will keep pressing the UK Government to bring that in as soon as possible. And I have written, as I informed the House last week, to Jo Swinson, the UK Consumer Affairs Minister, again to make that point. I would, however, recognise that there has been some movement in respect of regulation of payday loans, as I informed Jo Swinson when I met her fairly recently, and we welcome those steps forward, but we think the cap can be introduced earlier. Third, in July, our changes to the debt arrangement scheme delivered greater protection from accumulating interest and charges. In the first half of this financial year, almost a quarter of the people who entered the statutory debt solution in Scotland chose debt management instead of debt relief, a fact which shows the continuing year-on-year success of the debt arrangement scheme, of people that pay off their debts rather than seek to write off their debts. Fourth, this autumn we made changes to protected trust deeds in regulations to ensure inter alia that contribution payments could not be taken from a debtor's benefit income. Fifth, more recently, I launched at the Grampian Credit Union in Aberdeen our 12 Days of Debtmas campaign. This campaign will raise awareness across Scotland of the negative impact that high interest borrowing can have, and it also promotes credit unions as an ethical, sensible alternative. We will be debating, after this debate, John Wilson's work in this field on this topic, which I welcome. And I'm pleased to inform the House that thus far, more than 18,000 people have visited this campaign website. And I think a lot of members across the Chamber have worked hard on this. Kes Dugdale, I know, the River City, not a programme I follow avidly, I know is promoting this, and the very real-life consequences this have for people. So this is truly an issue of our time, and we have promoted that through the 12 Days of Debtmas campaign, which we will come on to debate later. So these are 5 positive, active, concrete steps we have taken this year, Presiding Officer. All of these initiatives support our vision of a financial health service, as does this bill, which delivers the most significant change to the bankruptcy process in Scotland for a generation and takes us closer to making the financial health service a reality. I'd like to thank all of the stakeholders who took part during stage one. I think all involved should be congratulated on a process which has demonstrated this Parliament's ability to scrutinise complex legislation in a thoughtful and constructive way. And I want to respond to a few of the major points. I'm afraid I don't have time to deal with all of the many recommendations, but some of the major ones I wanted to reply to directly. To begin with, first of all, the impact of the requirement to take advice in certain circumstances. The committee has asked what impact to this requirement that all debtors entering bankruptcy should benefit from advice from an approved money advisor will have in terms of client numbers. What will the impact be? If the increase was at the upper 8% end of the AIB's estimated range, and based on forecasts for bankruptcies in 2013-14, I'm told that the Accountant of Bankruptcy estimates this change will give rise to an additional 500 cases per annum across the whole of Scotland. I think this shows our changes will have a proportionate and manageable impact, certainly compared to the impact of the UK Government's welfare reforms, which will drive up the need for advice, and the CAB estimates in that regard that at the rate of 10 benefit problems for every 100 benefit claimants each year in Scotland. Secondly, the committee has expressed some concerns about ending automatic discharge in the bill. The key to make here, Presiding Officer, is that we expect that the trustee will apply automatically for the debtor's discharge unless there is evidence to show that the debtor has not cooperated. I think it's reasonable to say as a generality that that is not the case. In most cases, the debtors do cooperate, and therefore I think that that point in practice has to be borne in mind. However, we are looking at what would make this part of the process more straightforward, and we will see what we can do at stage 2 in order to achieve that. We take the technical criticisms made by bodies like the Law Society of Scotland on this aspect of the bill very seriously, of course. Thirdly, the committee has passed on concerns about the £10,000 threshold for entry into the minimal assets process, our new route into bankruptcy for debtors with a low income or an income solely from benefits. I'm happy to say that we will come back in January with an amendment to raise the maximum debt level. We are proposing an increase to £17,000, an increase which would set the threshold high enough to enable 75% of all current LELA cases to enter the MAP process. I hope this will help provide the necessary assurance that this important debt relief will be available to those who need it most. Fourth, the committee has raised the important issue of bank accounts for undischarged debtors. I think it's important that we look at this and do what we can to make the necessary provision during the amending stages, and I've written to the British Banking Association to enlist their support. Of course, there are a number of areas where the committee has agreed with the Scottish Government. I'm pleased that the committee has agreed our proposal to extend the payment period after bankruptcy to cover 48 monthly payments. I know, Presiding Officer, that not everyone supports this proposal, but I think it's important to have a debate on the basis of the facts. First, it is not correct to say that this change will mean that people in Scotland will have to pay back more to creditors than in any other part of the UK. This is because there are insolvency measures elsewhere in England and Wales, such as individual voluntary arrangements, where the payment period is not 4 years, but is usually 5 years. Second, at the same time as this change comes into force, we will be fixing the Common Financial Statement, which is already applicable in respect of DAS cases and from November in respect of protected deed cases, which is run by Money Advice Trust as the Scottish Common Financial Tool. This is important because it means that contributions will be set according to a consistent, transparent determination that our research has shown should result in a more sustainable level of contributions. We also recognise, as the committee has done, the importance of providing guidance on the practical operation of the tool to ensure that this works in practice. Third, it is not true to say that longer payment periods automatically lead to an ever-rising rate of breakages. In relation to DAS, for example, the proportion of live cases which are revoked per quarter has remained reasonably stable since 2011-12 at approximately 3%. Now, 3% of breakages, I think, means that there's 97% of DAS cases which are honoured, obtempered, where the debtor pays off his debts in full and paying off 90% of the debts, and that, of course, is strongly to be welcomed, and I'll do so in a minute, because, as paragraph 34 says, one of the objectives of this bill is that those who can pay should pay. I'll take the intervention.
Jenny Mara.
Thank the Minister for taking the intervention. It is my understanding that the European Commission have recommended that repayment periods should, in principle, 1 to 3 years and no longer than 3 years. And I understand that nowhere else in the UK do we have a payment period longer than 3 years. So why is the Scottish Government recommending, against advice of many of the people that gave evidence to the committee, that it should be extended to 4?
Minister.
Well, I'm afraid I do have to correct the member in a number of respects. First of all, so far as advice to the Scottish Government in the consultation process, there were 27 respondents who supported the 3-year option. There were 32 who supported a 5-year option. Therefore, our 4-year option plainly is a compromise, but a majority supported 5 years. Secondly, Ms Mara said that in England they do not pay for as long. Well, perhaps she wasn't listening to what I said a moment ago. What I said a moment ago is that individual voluntary arrangements, which are agreements which are payable in England and Wales, usually last for 5 years. That is longer than 4 years, not shorter. I'm afraid, Presiding Officer, that those who argue that the position in England is that debtors pay for a longer period are not taking account of the facts that the opposite is the case, because individual voluntary arrangements usually, not always for various technical reasons, but usually last for 5 years. So if, and as I understand, and I'll take the intervention in a moment, there is a campaign being mounted by the Labour Party, then I would suggest that they take advice from Tam Dalyell, who knew a bit about campaigning, which is that the first thing you do in a campaign is get your facts right.
Kezia Dugdale.
Thank you very much, President Officer. I wonder if the Minister would recognise that there's a difference between an individual voluntary agreement and bankruptcy, and what he's in fact doing is comparing apples with oranges.
Minister.
No, I'm very sorry to have to disagree to the member, because I respect the strong passion she brings to this topic and the work that she does. But it is simply not correct to say that we are comparing like with unlike. Individual voluntary arrangements are perfectly comparable with the insolvency arrangements in Scotland. And the truth is that this is a campaign which has got off to a faltering start because it is not founded on the facts.
Jenny Mara.
Thanks for giving way again, but I have the Accountants in Bankruptcy's analysis of the consultation in front of me, and the question is posed: if yes, what would that extension be? But the qualifying note under it says the majority of respondents who answered this question felt that an extension was not necessary, and they answered 5 on a hypothetical point. Would the Minister commit to going away and looking at the Accountants in Bankruptcy analysis again?
Minister.
No, I won't, because I've got the Accountant in Bankruptcy's analysis in front of me, because I rather thought this topic might come up. Question 10.41a. If yes, for what period? A, 3 years, B, 4 years, C, 5 years. The answer to A, as I've said earlier, was 27. The answer to 5 years, that is C, was 32. More than 3 years. There was a majority for a longer period than we are proposing. You could say that the numbers are evenly matched between 3 and 5 years. If you do, then it's difficult to see how it would be unreasonable to come forward with 4 years as a compromise, being exactly equidistant between 3 years and 5 years. There is another point, Presiding Officer, and I think this must be made, that in Scotland we think debtors who can pay their debts should pay their debts. And as I pointed out, those who pay under the debt arrangement scheme pay for an average of longer than we are proposing be paid in insolvency cases. That's because it takes longer normally to pay off your debts in full, but people want to do it, and most people do it. And I think that's something to celebrate, that most people do want to pay their debts when they can. Bankruptcy is a process that exists in order to provide debt relief, and debt relief should be provided, but it shouldn't be an easy option. And it shouldn't be an easy option not just because that would be unfair to those who enter into debt arrangement schemes, but because it would be unfair to people throughout Scotland who are paying their rent, who are paying their mortgage, not for 3 or 4 or 5 years, but for 20 or 25 years, and who expect people that are able to pay to be able to pay. So I think, Presiding Officer, it will be interesting to see whether this campaign is pursued beyond its faltering start, when almost every fact it's based on seems to be wrong. But moving to a conclusion, Presiding Officer, and reverting to the provisions of this bill, I'm very pleased to say that because we recognise that there are concerns about the funding of the financial education provision in this bill, we intend to support the rollout of this programme with an additional £200,000 of ring-fence funding. I informed the committee convener of this shortly before the debate. I hope this demonstrates the value that we place in this scheme, and I think it would be money well spent.
I'm afraid the Minister's
I'm very sorry,
finishing.
Perhaps in my closing. In closing, Presiding Officer, I think the report demonstrates there's a lot of solid work done. I welcome working further with the committee at stage 2 on amendments. I've indicated some areas where I think we will listen carefully and bring forward amendments. There are other technical areas too where obviously we will work with all stakeholders. This is very important legislation, and I hope that members will later on agree and support the bill.
Thank you. I now call on Murdo Fraser, who will speak on behalf of the Economy, Energy and Tourism Committee, after which I will be calling Jenny Mara. Mr Fraser, you have 10 minutes.
Thank you, Deputy Presiding Officer. I am pleased to open this debate on behalf of the committee. And can I start by putting on record my thanks to all those who worked with the committee, all those who came to give us evidence, the officials from the Accountant and Bankruptcy's Office, our committee advisor, Nicholas Greer, who with intelligence and good humour guided us through the sometimes very technical provisions of the bill, our SPICE researcher, and of course our team of committee clerks. The committee reached some worthwhile conclusions which we hope will improve the bill and their overall bankruptcy and debt advice process. And I was very interested listening to the Minister's comments. He's already preempted many of the points I was about to make, which means I will be able to ditch some bits of my speech, which is very good news because it was way more than 10 minutes when I stood up. Unfortunately, it's not going to make my speech any shorter as a result. Can I start off addressing this question of advice and education? Both separate issues, but I'll address them together. The committee recognised that support for money advice and financial education was not overwhelming. There was support expressed by Citizens Advice Scotland, the Step Change Debt Charity Scotland, Money Advice, but some support was more for the idea in principle rather than for the substance of the proposal. Some felt that financial education would be better provided on a voluntary basis rather than compulsorily. But the committee concluded it was important that money advice was available across all statutory debt solutions. We didn't think money advice would be an unnecessary burden on debtors, and the process for well-informed debtors could be relatively quick and straightforward. We also supported mandatory provision of financial education, but consider that some form of monitoring or pilot would be beneficial before it's fully implemented across the country. In relation to the question of cost of provision, there was a great deal of concern across organisations about the additional burden being placed on the advice sector with no additional resources in the bill, and the committee got a lot of evidence on this particular aspect and a suggestion from the money advice sector that they'll be looking at an increase of between 6 and 8% in cases. Now, I welcome the Minister's announcement just a few moments ago about the additional resources being made available. I'd be interested if you could expand on this a little bit more in his winding up speech and tell us where the £200,000 figure comes from and whether that is intended to be an annually recurring figure or is it there on a one-off basis. I'm sure the committee will be interested in hearing some more detail on that question. On the question of qualification of money advisors, we accepted that the quality, standard, relevance and consistency of advice given is important. Citizens Advice Scotland said advice should be suitable and appropriate to debtors' needs. and the committee were looking for a response to the Scottish Government to this concern. We also supported the call for insolvency practitioners to be included as approved money advisors, and we are looking for further information from the Scottish Government as to how it will monitor the provision of money advice. On the question of financial education in schools, a lot of witnesses told us they thought financial education would be better placed in a school environment rather than only at those who are in financial difficulty. Money Advice Trust referred to its research that said the timing of such educational interventions is crucial. We were interested to hear that both the Accountant in Bankruptcy and Money Advice Scotland are developing a module and national standard for financial capability education, and the committee is seeking details from the Scottish Government on what monitoring and review it will put in place with regard to the content of that module and the standard to which external bodies will be involved, and overall its question of its approach to teaching financial education in schools. And while we had a lot in evidence about how this financial education will be provided on an online basis, we were conscious that this is something that needs to be provided to everyone, including those who have access issues with online formats, not least because they might live in a rural area where broadband is of a poor quality. The committee spent quite a lot of time looking at the question of the common financial tool. The common financial statement will allow money advisors and debtors to identify a debtor's income and outgoings, for example, household expenditure, and what disposable income the debtor then has to pay off their debt. Now, there were different views expressed to the committee. Some people were concerned about the adoption of the common financial statement as the common financial tool. ICAS, the Law Society of Scotland, and Citizens Advice Scotland referred to flexibility and said it was too rigid. And there were strong concerns from the charity Step Change Debt Charity Scotland, who have their own tool and wanted to continue to use that. In the end, the committee came to the view that it would be preferable to have a single common financial tool, and it's better to go with the one being proposed in the bill, but we do accept this is a matter of judgment. And we also recommended that a cross-section of key bodies is involved in the preparation of the guidance that will accompany the new tool when it's introduced. More controversial was the question of the 48-month discharge period that the Minister referred to. The bill seeks to extend the debtor contribution from 36 to 48 months, although this could be shorter where a debtor makes sufficient payments from income or assets to settle their debts in full, or longer, either because the debtor has taken a payment break or because they agree to make payments for a longer period. We heard many concerns expressed about the rationale for this extension. For example, Citizens Advice Scotland concerned that the increased contribution period may result in a growing number of debtors unable to maintain those contributions, resulting in increased hardship. And other concerns were expressed by, for example, the Association of Business Recovery Professionals, R3, Scottish Technical Committee, Carrington Dean and ICAS, again questioning whether any analysis has been carried out of debtor contribution breakage timescales or the cost-benefit to a sequestrated estate of this extended time period. Now, the Minister told us he thought 48 months was about right. We've heard that again this afternoon, but there were strong views from a cross-section of organisations taking the opposite view. On balance and on a division, the majority of the committee supported the proposal in the bill. The question of undischarged bankrupts and bank accounts came up in evidence, not an issue in the bill, but an issue which could be addressed at stage 2, and I was interested to hear from the Minister that he is intending to take that forward. I think that is something the committee would welcome. The bill brings in a new minimal assets process for those with little in the way of income or assets as an alternative to the low-income, low-assets or LILA route, as it's sometimes known. The Scottish Government believe the entry criteria will be clearer, and alleged confusion amongst stakeholders that since the LILA route was introduced, it has been necessary to transfer a number of cases from it to full bankruptcy because the criteria for accessing the route were not made clear. We heard a range of views about the proposal allowing debtors under the MAP to exit their bankruptcy after 6 months. Some people felt it was far too short, including the Law Society of Scotland. The committee recognised a well-intentioned purpose behind the introduction of the 6 months discharge period under MAP, and we therefore considered a cautious approach should be adopted by the Scottish Government, particularly as the MAP will apply to arguably the most vulnerable of the debtors. And on balance, we agreed to support the provision, but invited the Scottish Government to publish, 1 year after the MAP is introduced, a report on the impact of this new early discharge provision. There's a lot of discussion at committee around the fee level. The bill provides for a fee in the region of £100 to be charged for the new MAP. Citizens Advice Scotland were concerned that there would be a fee at all for MAP, and it said some debtors would struggle to afford it, and there were other concerns about the level of it. We heard from the accountant in bankruptcy that she has to ensure that her organisation balances its books and takes money in to cover its cost. And it appeared to the committee that one of the reasons for the use of the application fee under the MAP is to ensure that the office of the AIB as an executive agency will be self-funding. And so we again divided on this, but after a vote agreed that the £100 figure was the correct one, because we recognise the need for the AIB to cover its costs. Yes, if I have time.
Mike Mackenzie.
Yes.
I'm sure that you recall, as I do, Convener, that the accountant in bankruptcy gave an undertaking to see, if possible, she could reduce the fee below £100.
Murdo Fraser.
Mackenzie is absolutely right, Presiding Officer, to remind me of that particular fact, and I hope that is something that can be taken forward with time. We did hear some concern about the maximum debt level for the MAP of £10,000. This is an issue I can now very quickly move on from, because the Minister has already announced that will be increased to £17,000, and I think that is something the committee members would generally welcome. One other area, very briefly, if I can cover, that's quite important, Presiding Officer, is the question of the transfer of functions from the courts to the AIB. There were strong views expressed to the committee around this, whether the AIB had insufficient expertise in the areas of law or insolvency practice to take on some of the roles proposed. Understandably, we heard this from the Law Society and those representing insolvency practitioners, and concerns about potential conflicts of interest. To be fair, this was robustly defended by the accountant in bankruptcy, arguing that there would be expertise in our office in order to deal with this, and there would be internal review. It is an issue where the committee was in the end content to give its approval in principle to the proposed transfer, although we are inviting the Scottish Government to respond to a number of issues.
I'm sorry, the member's over his time, Ms Mara.
I think, if I can just say in closing, Presiding Officer, and thanking you for your forbearance, I look forward to hearing the Minister's responses in winding up this debate and further responses in writing from the Scottish Government. It was a view of the committee, though, on balance, that we should support the general principles of this bill at stage 1. Thank you.
I now call Jenny Mara. Ms Mara, you've got 10 minutes, and Ms Mara will be followed by Cameron Buchanan.
Thank you, Presiding Officer. Today's debate and this bill are about how we treat those who have come forward to access the safety net of the state in bankruptcy, who, in an age of recession, payday lenders, stagnating wages and rising living costs, are facing the consequences of bankruptcy, the loss of the family home, of possessions and even their job. And I think in this debate we have an important choice to make, a choice that defines the kind of economy we want for Scotland. In supporting this bill, we can choose to push those in the greatest need further away from financial inclusion for longer, a choice worth making if you believe our economy should serve those with the assets and wealth to carry on regardless. Or we can choose that economies should and can serve a wider social good when they are built to include and empower every person, especially those who have lost everything. Labour will vote against the Bankruptcy and Debt Advice Bill tonight because we simply cannot accept a bill which recognises the need to fund our bankruptcy service entirely from the fees of the bankrupt. A bill which proposes to hold Scots in bankruptcy for longer than in any other part of the United Kingdom, and which restricts access to help for those on the lowest incomes. Presiding Officer, I think... Yes.
Murdo Fraser.
I'm very grateful to Jenny Murray for giving way. Can you explain, if Labour intend to oppose this bill, why the Labour members of the committee were happy to sign up to the general principles?
Jenny Mara.
I would say to the member, on reflection of the whole bill, I think there are several problems with it which I will go on to outline, and that will explain our position. No, I'd like to make a bit of progress, Minister, if that's okay. Let's contrast for a moment the legislation we have before us today with the debt arrangement scheme that was introduced in 2002 by the then Labour-led executive. Now, that scheme replaced the punitive pounding and warrant sales, and in doing so empowered those in debt with realistic rights, freed them from the threat of legal action, and by virtue of the state intervening, created workable agreements between debtors and creditors. Why? Because the executive then recognised that helping people and businesses out of sequestration as quickly as possible and relieving them from the stigma of bankruptcy was in the interests of our whole society. Now, the consequences of bankruptcy affect us all, from the mental and physical health of those going through it and the toll it takes on their loved ones, to the loss of small and medium-sized enterprises that form the backbone of our economy in Scotland. It is in the interest of all of us to ensure that as many people as possible are financially included. Now, this is a view... No, thank you, Mr Mackenzie. This is a view which has been reiterated by the European Commission as recently as 2011 in their report, A Second Chance for Entrepreneurs. In that report, they state, fear of bankruptcy and its consequences acts as an effective deterrent to entrepreneurship. An effective second chance policy is fundamental to send a message that entrepreneurship may not end up as a life sentence in cases where things go wrong. And specifically on systems, I'd like to make, can I take it after Mr Mackenzie? And specifically on systems of discharge, they add, a modern system for discharge is paramount to reduce the stigma of bankruptcy. In this system, discharge should be as automatic and as reasonably limited in time as possible. In principle, 1 to 3 years could be a good target to aim for. Contribution beyond the period of discharge is not reasonable, and all debts should be discharged after this time. I'll take you now.
Mackenzie.
Thank you for taking this intervention, and I'm really delighted to hear that you have concerns for entrepreneurs. Are you aware that very often creditors are entrepreneurs, small businesses who at the end of a bankruptcy process result in only a very, very small return on their money, if anything at all, and that their interests are also part of the scope of this bill?
I am very well aware of that. I don't think the balance is right, Mr Mackenzie, and that's why we are opposing it. In contradiction of the principles underpinning our current legislation and against the Commission's advice, which I have just read, the SNP are proposing to end automatic discharge entirely and extend the payment period for bankruptcies to 4 years from 3 at a time when the economy is growing at just 1%, when wages are frozen and fuel and food bills continue to rise. I think it is an illogical and iniquitous move, and it's one which has been, I will in a second, it's one which has been condemned by the STUC, the Law Society, the Church of Scotland and others. Yes,
Minister.
Well, I hesitate to say this, but I do wonder if Ms Mara has read section 16 of the bill, which does not provide what she's talking about. It does not provide a fixed period of 3 years. It talks about a period of 12 months subject to the application being made by the accountant in bankruptcy. Does she understand what this bill in fact is proposing?
Jenny Mara.
Yes, I do, and I'd like to make a bit of progress. The government tell us that they are creating a bankruptcy service for the 21st century. But what could be more Dickensian than dragging out the misery of thousands of Scots while placing an administrative burden on the money sector? It is little wonder that 75%, as the Minister and I discussed a little while ago, of those who responded to the Scottish Government didn't want Scots to suffer under the longest bankruptcy period of anywhere in the UK. And I am confused, Minister, about the fees going from £200 to £100, because it was only last May in the Justice Committee where John Swinney came to committee and proposed to raise the fee for bankruptcy under the LILA route, I will in a second, from £100 to £200. I don't think you were available to come to committee that day. The Finance Secretary came, and the reason he gave for the fee going from £100 to £200 was full cost recovery. Is it costing any less now, Minister?
Mr Minister.
Well, we don't think the taxpayer should be put to extra expense, and if the Labour Party thinks that the taxpayer should take up responsibility for matters which they do not pay for at the moment, then they must bring forward budget amendments to that effect and say where the money will come from. But I wonder, since Ms Mara says that 4 years is far too long a period for debtors to pay, even when they can pay, and they do pay in other parts of the UK for a longer period, why did the Labour members not oppose the period of 4 years, exactly the same period, when it was introduced for protected trust deeds, when they considered the regulations on committee?
Mr Ewing knows that all the evidence committee shows that 3 years is better than 4. I am still confused, and I am not given any comfort by his answer on why the SNP have flip-flopped on this fee arrangement and just raised it last year. Would I be cynical enough to say they raised it just so that they could reduce it again in this bill? I don't know. Maybe the Minister can tell us later. I think the message this bill does send: when you go to your government for help with debt, the response is to make you borrow more to pay for it. Because no sooner did the Minister have to U-turn and drop the £200 fee just 1 year after introducing it, than we hear him come to the Chamber today and U-turn again on the £10,000 cap before his bill has even cleared stage 1. And while we welcome the fact that the Enterprise Minister has bowed to the pressure of those working in our money advice sector and their advice, it only serves to prove that the SNP have had the wrong principles and the wrong priorities at the heart of this bill from the outset. Scottish Labour has argued that for those with the least assets and incomes, there should be no barrier to bankruptcy. Even the £100 fee which has been proposed by the Minister is enough to deter people from seeking the help they need. And I am very pleased to hear Murdo Fraser and Mike Mackenzie point to the evidence in the committee where the accountant in bankruptcy gave assurances that it might even be lower than that. Presiding Officer, these are just a few of the issues we have with the bill, and my colleagues will address several more. But I want to end by saying we cannot and we will not support a bill which contains the regressive measures this one does. It is our ambition to build an economy that empowers every person in Scotland through financial inclusion, and we won't limit that ambition by voting for this bill today.
I now call Cameron Buchanan. Mr Buchanan, you have 6 minutes.
Thank you, Presiding Officer. I'm pleased to be able to speak in this Stage 1 proceedings on the Bankruptcy and Debt Advice Bill, and wish to also thank the committee for its deliberations. This is obviously a fairly complex bill with many different facets, but I think it's important to keep in mind what the overall object of the game is. For me, there's a balance to be struck. Statutory debt solutions should be the means of last resort and should encourage as much as possible the payment of debts. I don't simply make this as a point of principle, but also because it's important to bear in mind that not all creditors are faceless multinationals who can easily absorb bad debts. When we consider that individuals who seek this option may also be entrepreneurs, then creditors will also be SMEs for whom the default of a debt is not an easy burden to bear. That said, we must shy away from the punitive system of bankruptcy and debt management. In this context, I was very interested to note some of the findings of the European Commission 2011 report on entrepreneurs. A key point which was raised was the rehabilitation of those who had been through the bankruptcy process and preventing the fear and stigma of the process being a barrier to future entrepreneurs. If we look at some of the most successful, Scotland's most successful business people, I think we'd be surprised by the number who faced a very difficult time, particularly in the initial start-up phase. Accordingly, we should not lose sight of the fact that the difference between a failed entrepreneur and the next big enterprise success story can be a very fine one indeed. We have many examples here in Scotland: Michel Malone, abroad Calvin Klein and Ralph Lauren himself. On the face of it, bankruptcy and debt advice appears to strike that balance. I'm minded to support it accordingly. That said, I think there are details which need clarification and given further consideration. One of these issues which will have to be reviewed is the extension of the period for which a debtor contribution may be made from 36 to 48 months. We've already spoken about that. But going back to my initial point about striking a balance between the interests of debtors and creditors, this provision is unusual, as there seems to be little evidence that the change will benefit either group, and I should be interested in hearing more about that. The Technical Committee of the Association of Business Recovery Professions questioned the benefit to creditors and charities as a step change raised this very real prospect of increased debt defaults and the repayment arrangements being therefore broken. Indeed, a number of bodies pointed out that the only certainty with this change would be the consequential payment of trustee fees, a point of which I'm sure is unrelated to the Insolvency Practitioners and Association's broad support for the proposal. Given that this proposal was omitted from the initial consultation and many respondents to the committee evidence sessions questioned the lack of evidence to support this change, I think this is one aspect where the government must carefully consider its position. Yes. Certainly.
Mike Mackenzie.
I appreciate the member did not have the benefit of sitting through all the evidence sessions that the committee did, but would you take it from me that we heard absolutely no evidence at all to support the proposal that the extension to 48 months was a bad thing?
Mr Buchanan.
Difficult one for me to answer as I wasn't on the committee. As to the debt advice aspect, I'm sure many other members will draw attention to the weight of evidence pointing out how the free money advice sector will cope with any extra demand. I'm aware that the government's position is that we are looking at an estimated 6 to 8% increase in the volume of cases dealt with. However, as a number of groups giving evidence pointed out, many free advice providers are already at capacity, and regardless of how small the added increase may appear, there is no more room at the debt advice inn. The other feature of our debt solution framework, which the bill must ensure, is a good deal of flexibility. This issue apparently cropped up in relation to a number of distant aspects, the most obvious of which is the proposed common financial tool. As the committee report stated, there must be scope to amend, qualify and justify the data around the debtor's income and expenditure. The Law Society of Scotland was amongst those who warned of the dangers of such a tool becoming too prescriptive. I think we should heed those warnings. Indeed, it would be the same sense of flexibility which would seem to drive the government to formalise arrangements over payment breaks, an aspect, again, which we broadly welcomed. Of course, the danger, I think, is that in making statutory provision for such breaks, we lose the degree of flexibility that is already there in practice. So we must have clarity, I think, from the government on how it would ensure sufficient scope with its proposals to adapt debtors to changing circumstances. The one issue where there's a clear difference in view on the bill between the committee and the government, and which must be reconsidered, I think, at stage 2, is that of ending the automatic discharge. The motive of the government to provide a stronger link between the debtor cooperation and discharge is one of which we would all agree with. However, there is a great deal of evidence about the difficulties of objectivity judging whether someone had been cooperative, particularly when judged against the proposed statement of undertaking. Again, there must be sufficient flexibility in the proposals for those who are affected by the changes in such circumstances, and any moves to remove automatic discharge should be approached, I think, with extreme caution. Presiding Officer, whilst I wait for the government to clarify its position on a number of these things, I am content to support the general principles of the bill at this stage.
Thank you, Mr Buchanan. We now move to the open debate. Speeches are 6 minutes. We are pretty tight for time, so I'd appreciate if members could keep to their allotted time. Mike Mackenzie, followed by Kezia Dugdale.
Presiding Officer, I should start by thanking the committee clerks and advisers and all those who gave evidence to the committee and assisted us in what I think was a useful examination of this bill. And in particular, I'd like to thank those who gave evidence in private, sharing with us their difficult and painful experiences as they wrestled with their debts and with a system for dealing with these situations that is not always as good as it could be. It became apparent when taking this evidence that most of the people who fall into debt do so not because they lack ability in balancing their budgets or controlling their finances, but through misfortune and events beyond their control. And like the committee, I therefore welcome this bill because it's necessary to update and improve the processes for dealing with debt and to seek ways to be fairer to both creditors and to debtors, and I fully support the aims of this bill, which aims to ensure that appropriate proportionate debt management and debt relief mechanisms are available to the people of Scotland, which are fit for the 21st century. I should say at this stage, Presiding Officer, that there has been some criticism from opposition members that the legislative programme for this year is insubstantial, that Scotland is on pause and that bills like this one are somehow unimportant. I'm sorry to hear Jenny Mara, for instance, suggest that this afternoon. But like me, I think my fellow members in the committee would disagree with this view and would wish to refute it. The bill amends the Bankruptcy Scotland Act 1985. Imagine if we were restricted to running our computers on the software available in 1985. To the extent that legislation is like a society software, I think most members would agree on the need to update and amend where we become aware of faults and where improvements can be found. And this bill might seem to be unimportant, but only if you are fortunate enough not to be in difficulty with debt or not unlucky enough to be a creditor who is not being paid. During our scrutiny, it became obvious to the committee that in places this is a technical and a complex bill. All the more need then for advice to be mandatory for those seeking the most appropriate debt solution and not just the solution that's most convenient for their trustee. And along with this, there is a necessity for this advice to be consistent. And that's why it's important that there should only be one debt tool. And whilst I'm sure that the other tools have got some merit, nobody was really able to explain this to the committee and what the superior merit was. And therefore, the choice of the money advice tool seems to be as good as any other choice. And I was glad to note that this tool offers flexibility so that it's capable of responding to individual circumstances or difficulties, because this seems to me to be essential if such tools are to be successful and to be the basis of calculating debt solutions which are both fair and manageable for debtors. I think it's worth noting also that in seeking solutions which are fair and manageable for debtors, the best interests of creditors are also served, since there is no virtue whatsoever in debt solutions that prove to be unmanageable. But I must say a word about creditors, because their interests are sometimes neglected. An important aspect of any debt solution is the need to be fair to creditors who have provided goods or services in the good faith that they'll be paid. And I don't share Jenny Mara's view that the status quo is acceptable, because the committee heard evidence that returns to creditors are something of the order of 17 pence in the pound. That doesn't seem to me to be supporting entrepreneurship in the way that Jenny Mara described. So extending the repayment period to 48 months for those who are able to make repayment, and we heard from people who unfortunately have entered into bankruptcy but who earnestly wish to repay any money due for the sake of their self-esteem. That 48-month period, I would say, is therefore reasonable. And despite some concerns that we did hear about the possibility of this leading to defaults in payment, we were not presented with any evidence, any real evidence to suggest that this would be the case and to back up this concern. Briefly, Mr Malik.
Hansel Malik.
Thank you very much. It's just to let you, to say that you had suggested that there was no evidence that people were opposing the 4-year. And let me tell you that there was suggestion by many organisations, and particularly Money Advice Scotland, who went on to say that in this economic scene it did make sense to increase the period. So there was no one actually said that it doesn't make sense. Everybody disagreed with the 4-year.
Mike McKenzie.
Thank you, Mr Malik. You're correct in what you say, but I think you and I perhaps have a different standard of what we think of as evidence. Merely saying, I don't like this or I don't think it's good, I don't think constitutes evidence. What I was referring to, and this will perhaps, I see Mr Fraser is shaking his head, this might clarify it. If they were able to point to studies of where this had been done elsewhere in other countries and that proved that breakages increased, then I would have accepted that as evidence. But just saying I don't like it, I don't think is good enough.
You need to bring your remarks to a close.
Presiding Officer, the heart of this matter is the need to strike a careful balance between the interests of debtors and creditors. In finishing, though, and before I finish, I must pay tribute to the accountant in bankruptcy. In my dealings with them on behalf of constituents, they have been both efficient and fair-minded. I'm pleased, therefore, that they will play an increasing role in providing debt solutions that are efficient, fair and reasonable.
Thank you. We now move to Kezia Dugdale, to be followed by Joe McAlpine.
Thank you very much, Presiding Officer. And can I first of all draw members' attention to my register of interest, where I'm a co-op MSP and a member of Capital Credit Union. That will become relevant in a second. I've got particular interest in this issue due to the campaign I've been leading around payday lending. And I think it's important to recognise the changing nature of personal debt in Scotland at the moment and the degree to which it's becoming a bigger and bigger problem. Payday loan companies have really only been booming since 2008, and it was in 2012 that they reached £2.2 billion share of the UK economy, with 8 million payday loans alone in 2012. That poses new challenges for the bankruptcy and debt advice landscape because people find themselves spiralling into debt at a far faster rate than previously before, and also it's debt created over smaller amounts of money. We covered this territory in last week's debate, but £5,000 borrowed from a payday loan company is far more significant than £5,000, say, in the context of a payday loan, of a personal loan, and we need to understand the different role that interest rates play in that process. I welcomed the government's changes to the debt arrangement scheme earlier this year. I welcomed them because I'd been campaigning for them alongside the Govan Law Centre. And the reason that those changes were important is that it previously used to take 3 months for people who were applying for a debt arrangement scheme to get on the debt arrangement scheme. And during that period of application, you were still accruing interest. So if you'd borrowed from Wonga, you were still getting applied a monthly interest rate from their horrific annual percentage rates. So it was really important, the step that the Minister took, to freeze interest rates at the moment that people applied for a debt arrangement scheme, and that's made a considerable difference to the lives of people who have that type of debt. Given that he was so willing to listen to campaigners earlier this year, I had high expectations for this bill, and I really thought that the Minister would come forward with some more progressive ways and means of taking on the payday loan companies. And I'm afraid that I was disappointed to read the detail of the bill, and I want to go through 3 aspects for that. We've already touched on the issues around discharge moving to the 48-month period, and I want to try and address some of the questions around that have been raised in the debate so far. I'm afraid the Minister is wrong. There is a distinct difference between an individual voluntary agreement and a statutory process of bankruptcy. They are not the same thing. So I ask the Minister to find a comparable situation across the United Kingdom where a bankruptcy measure exists for more than 3 years over a period of time. Jenny Marrett is right when she says that it's the longest period of anywhere in the United Kingdom. I'm afraid that the Minister dances on ahead of a pin in order to deny that. I'm also keen to have a look at who supports his position. And if you look at the evidence, Presiding Officer, there aren't very many significant organisations who support him. In fact, there's a broad range of opposition from Lloyds Bank to Step Change who oppose his position on the 4-year issue. And I think he's uniquely managed to get the CFA, the Consumer Finance Association, Citizens Advice Scotland and Money Advice Scotland on the same page in their opposition. Who'd have thought that the Trade Association for Payday Loan Companies would be agreeing with Citizens Advice Scotland that what the government was doing was a bad thing?
Minister.
Well, I repeat that 32 of those who responded to the consultation actually wanted a payment period of 5 years, longer than we've proposed. That's a fact, and I will write to the member to list those 32 respondees. But I'm still really waiting for answer to what seems to be a mysterious event, which is why did the Labour members, if they're so strongly opposed to a 4-year period of repayment, and this seems to be the reason or the main reason why they're now, contrary to what they did in committee, going to be opposing this bill, why did the Labour members then agree to a 4-year repayment period for protracted trust deeds, which is simply another insolvency procedure?
Delighted to answer that point, Presiding Officer, and I'll do that in 2 parts. The first thing, I think, is the new evidence that we heard from Step Change that actually moving from 3 to 4 years could see the default rate increase by 15%. So this mechanism of going to 3 to 4 years, far from getting more money paid back into the system, could lead to more people defaulting and less money going back into the system. I think that's quite a compelling argument. The second point I'd like to raise is around the people who are in support of the government's position on this. And I find myself sitting against my credit union colleagues on this because it is in fact ABCL who are one of the supporters of what the government is doing on this issue. And let me address why I think that is. I'm a proud member of a credit union, and a critical part of our Debt Busters campaign is promoting credit unions. But I think their support for the government on this issue is led by the fact that they are very often at the end of the queue when it comes to the debtor process. They do not have preferred creditor status. So they're at the end of the queue when people are paying back their debts. Further to that, they charge much lower interest rates. So they need people to pay back over a longer period of time in order to recoup the cost of the lending that they go through. So in that sense, it's no real surprise that the credit unions support the government's position on that. The other issue I would raise in regard to that, Presiding Officer, is that credit unions only constitute 0.5% of all debts held in bankruptcy. So although I support credit unions, and I understand the Minister's point, he's making a change to the system which doesn't reflect 99.5% of the debtor's estate. He shakes his head, but I'd like to hear why that's not the case, and I'd be happy to take an intervention on that point.
You may well be, but Minister, Ms Dugdale's got 30 seconds to end.
Perhaps the Minister can come back to that in closing, Presiding Officer. Can I just make one small point about the MAP cap? That's the minimum asset process. We currently have 100% of people being able to access that. There's no cap at the moment. So he's introducing a cap which will see 75% of people be able to access that process. There is an example of somebody who would fall out of that. That's somebody who's become ill, had their house repossessed, find themselves in a position where they are on benefits but have no assets, but might have arrears from their mortgage. That type of person will currently be excluded from what the Minister is proposing. That's a case study being given to me by an insolvency practitioner. I'd be delighted to write to the Minister in that regard. There's a lot more to say about financial education, but time has run out, Presiding Officer. I'm afraid there are a multitude of reasons why I can't support the Minister today.
I now call Joe McAlpine to be followed by Alice McInnes.
Thank you, Presiding Officer. Later today, my colleague John Wilson will lead a members' debate on the 12 days of Deadmas, as the Minister has already said. Rather than overlap, the two debates today complement one another. The 12 Days of Deadmas is a Scottish Government campaign that warns against payday loans and encourages people to instead join a credit union. As the previous speaker has already said, credit unions have given important evidence, both written and oral, that informs the committee's report on this bill. I therefore want to look more closely at what credit unions have to say about the legislation, given their widely recognised role as responsible lenders whose only interest is the financial well-being of their members, as opposed to shareholders, investors and highly paid banking executives. Credit unions are also in a position to lend to groups who might otherwise have difficulty accessing finance. I was pleased, therefore, to note that the Association of British Credit Unions Limited, ABCUL, welcomed many of the key measures in this bill. In their written evidence to the committee, they singled out a number of measures for praise, including the requirement for anyone seeking debt management of statutory credit relief to receive advice from an approved money advisor, but they emphasised that this person should be independent, which I think makes a lot of sense. They also include the measures on financial education and the adoption of a single standard financial tool to calculate contributions in debt repayment programmes, protected trust deeds and bankruptcies. Crucially, they also welcomed the proposal to extend the repayment period of PTDs from 3 years to 4, as well as the proposed power for the accountant in bankruptcy to refuse to discharge a debtor who has not complied with the terms of their bankruptcy and who has not cooperated with their trustee. Presiding Officer, as the Minister has already said, debt is one of the major problems facing the people of Scotland in the 21st century, in particularly unmanaged debt leading to bankruptcy, and we must take steps to address it, which this bill seeks to do. Many people run up debts for all sorts of reasons, not least the financial crisis, unemployment and illness, and it's in no one's interest to keep them in an extended state of penury. That would be inhumane and also bad for the country's economic confidence, particularly in terms of encouraging entrepreneurship. However, this bill does not do that. It makes an effort to balance the needs of both debtors and creditors. With regard to debtors, I welcome the Minister's announcement in response to the committee's concerns that he intends to raise the cap on entry for the MAP from 10,000 to 17,000 worth of debt. This will directly benefit the most needy. But we must also recognise, as my colleague Mike Mackenzie had already said, that debtors are not the only victims of debt. Small creditors are often crippled when bills are not paid. And one of the issues that I raised as a substitute member of the committee was an organisation in my own constituency, which was an arm's-length organisation, DG Arts, which collapsed owing money to a lot of small businessmen and artists. Now, that was 2 years ago, and at the time of the committee taking evidence, those creditors had still not been paid. One creditor, a constituent, contacted me to say he was owed £1,200 and he was being offered 12 pence in the pound, which is below average. And it also left him with considerably less money than the insolvency practitioner charged per hour to administer that over 2 years. The British Credit Unions Association made clear in evidence that there have been too many cases where the main beneficiary of insolvency is the insolvency practitioner himself.
Yes. The member is absolutely right in what she says. I wonder if she thinks that credit unions could have preferred creditor status in a process like that and therefore be further up the queue when it comes to paying back debts.
Joe McAlpine.
Yes, I would agree with that. Frank McKillop of ABCUL made it clear in oral evidence that he felt creditors are currently at the back of the queue when there's an insolvency. He pointed to cases where a debtor entered a trust deed and made no discernible adjustment to his or her lifestyle to the extent of continuing to enjoy luxury holidays. There's long been a concern about the transparency of protected trust deeds and the way that the high costs of fees and outlays can sometimes swallow up any return to creditors, and which this bill is designed to address through the standard financial tool. As the Minister himself pointed out to the committee, a third of protected trust deeds will pay no dividend whatsoever, and in some trust deeds, more than half the monies gathered go on to administration costs, with these costs often rising by as much as a quarter over the lifetime of the case. It's often said that insolvency practitioners have been the highest beneficiaries of the crisis that began in 2008, and a very extreme example of this might be the £40 million in fees accumulated by the administrators of Woolworths after its collapse. We are not dealing with that scale of insolvency here, but on a much smaller scale abuses do occur. That's why I very much welcome the support given to the bill by the Economy, Energy and Tourism Committee. It's a progressive piece of legislation which I am happy to support. Thank you.
Thank you. I now call Alice McInnes to be followed by Nigel Dawn.
Thank you very much, Presiding Officer. Scottish Liberal Democrats welcome the fact that the Scottish Government is taking steps to ensure that people are able to access the debt management which they need. We believe that the policy aim of the bill to ensure that appropriate, proportionate debt management and debt relief mechanisms are available to the people of Scotland is fundamentally sound, and we will therefore be voting for the bill at decision time today. Whilst the ambition of the bill is laudable, we do have a number of concerns, some of which have already been raised today by other members, which I hope will be addressed at stage 2. Firstly, we must ensure that there is sufficient support for the financial advice and education sector. We therefore support the committee's view that more work is needed on the provisions for the advice sector to establish whether the requirement for money advice will place an additional burden on those who offer advice. We also share the view that a pilot financial education project, or at the very least careful monitoring of its outcomes, may be helpful before mandatory provision, as set out in the bill, is introduced. It seems to me there is little point in having an enforced system of financial instruction if it cannot be shown to have a positive impact. Of course, the debt advice given to individuals in what can be very difficult and stressful situations must be the right advice, in the right manner and in a timely fashion, and so there should be recourse for bad advice. We very much welcome the work of the Accountant in Bankruptcy and the Money Advice Scotland on developing a module for a national standard for financial capability education. Learning how to budget and manage money better is an invaluable skill to teach our young people. So education early in life on money management and financial services is essential if we are to ensure that our young people have the life skills they will need later in life and throughout adulthood. I've listened to the Minister's points. Nevertheless, we continue to have reservations on the extension of debtor contribution orders to 48 months. The 4-year bankruptcy would mean that those who are in very difficult financial situations pay for longer, which may cause additional financial hardship. This could lead to debtors breaking agreed payment schedules, as we've heard from Hanzala Malik, a concern raised by Margaret McDougall, I think, during considerations. We agree that those in debt should be made to pay back what they can, but there is a fine line between ensuring that people pay creditors what they can and pushing them into further financial hardship and misery. Yes, certainly.
Minister.
Does Alison McInnes accept that under the debt arrangement scheme that the average period is in excess of 6 years, and therefore that debtors who can pay are paying for 6 years, 2 years longer than those who enter into debt relief options, either bankruptcy under these proposals once they're implemented, or protected trust deeds, which will be 4 years?
Alice McInnes, I can give you a wee bit extra time for taking that intervention.
Thank you very much. Thank you. I know what the Minister says, and of course he's correct, and I must correct myself. It wasn't Hazana Malik who said it, but it was Kezia Dugdale who pointed to the increase in the debtor default over the longer period. And so I think we need to just consider carefully where we're going with that. On the removal of judicial involvement and the increased role of the accountancy in bankrupt, we share the concerns raised by the Law Society of Scotland, which argues that judicial determination is a fundamental right in cases of sequestration and that conflicts of interest arise with the proposed increased scope of the AIB. And others have raised concerns about the conflicts of interest. For example, the Royal Faculty of Procurators in Glasgow stated in its submission that from the point of view of natural justice, it would be inherently unfair that the party who decides to seek a bankruptcy restriction order is also the party which considers counter-representations by the debtor and is the party who ultimately decides whether or not to grant the restriction order. So, yes, certainly.
Jenny Mara.
For giving way. I don't know if the member would note that in the government's own policy memorandum to this bill, they note that one of the reasons for the transfer to the accountant in bankruptcy from the courts is the pressure our courts are under and the increasing amount of business, but that this government isn't helping matters by closing our local sheriff courts.
Alice McKinnon.
Of course, Ms Marable know that I agree entirely with her on that matter. And what I was going to move on to say is that we must be sure that the bill is true to its policy aim, that is appropriate, proportionate debt management and debt relief mechanisms for our citizens. And we shouldn't muddy the waters with changes which aim at no more than something that is administratively comfortable or easy. We support the committee's view that a cautious approach needs to be taken to the proposals for a 6-month discharge period under the minimal assets process. We hope the Scottish Government will undertake to publish a report on the impact of early discharge after a year, with a view to making improvements if necessary. Finally, we are cautious about the ending of automatic discharge and would like the Government to consider its position again on this. If necessary, grounds for deferral under current arrangements could be widened to include debtor cooperation, which would, we feel, be a better way forward. We will be supporting the bill at decision time today, but there is still a lot of work to do. Our future support will be dependent upon the concerns raised by myself and others being properly addressed at stage 2. Thank you.
I now call Nigel Dawn to be followed by Hanzala Malik. We have a very little time in hand, so if you were to take interventions, we will compensate.
Thank you very much indeed, Presiding Officer. Can I go back to basic principles? I think we're clear that what we need to do is to get Scottish folk back into an economic society. Those who've finished up not being able to pay their debts should regard bankruptcy as a last resort, designed to provide rehabilitation and to enable them to make a fresh start. Those who have serious and unmanageable debts need to be relieved of them in such a way that they can get back into life. And I do very much like the idea of a financial health service, which is why I suspect I should start this discussion by reflecting on what it is we teach in our schools. Do we teach our children at home and at school to look after themselves, their bodies and their minds? I think we do. That's because it actually reduces the demands on our, what we call the health service, later on. What undoubtedly we should do in our schools and in our homes is to encourage our youngsters to understand how to manage money in such a way that when they do later in life, they can do so safely. For those who then finish up not having done so and finish up in some kind of financial mess, the debtor should, I think, be forced to rethink his or her financial activities, to repay what he or she reasonably can, and then to be discharged. And that, of course, is what bankruptcy is all about. Now, I don't have the answer to every question that's been raised in the debate so far. I'll leave that to the Minister, of course. But I have heard discussions already about payday loans, credit unions, and I'm just wondering whether we might, in our thinking, consider whether those are actually business suppliers. Because I think most people who do they are suppliers of credit to businesses who are going bankrupt, let me put it that way. Because it does seem to me that most people in business go bankrupt once they've actually squeezed their suppliers' credit as far as they can go. And I'm just not convinced that payday loans or credit unions have got much to do with that entrepreneurial problem. Undoubtedly, they will have to do with individual people finishing up bankrupt, but I doubt it has much to do with entrepreneurship. So I would ask that people consider that in their further discussion. I noted what Mike McKenzie said about most people who go bankrupt actually do so due to events totally outside their control. And that does suggest to me that one of the things we need to teach, and not just at Harlow Business School, is that not only do you have to be able to add up the pounds, shillings and pence on each side of the balance sheet, and I betray my age, of course, but also to understand that prudence is a pretty usable thing to bring along. And if you have one big debtor in your business, then you are considerably at risk. I'd like to rush on and pick up one or two other issues, particularly ones which others haven't addressed. I do like the idea of a common financial tool. Consistency has a lot of merit, doesn't it? And I also note that the Minister has suggested that it's actually more sustainable. That does seem to fit the basic purpose. I note that the proposals that money should be deductible from wages. That does actually seem pretty reasonable. Now, the objection to that came from those who pointed out that some folk would lose their jobs under those circumstances. I think I have to express a lot of sympathy for that position, but quite clearly, if you put yourself in that position, you may have to live with the consequences. In general terms, if you don't keep up with payments, deducting from wages would seem to have some merit. Happy to take.
Kezia Dugdale.
I wonder if the member could clarify whether I've heard him correctly. He thinks it's appropriate for creditors to be able to go to an individual's employer and ask to try and seek that debt back from their employer rather than that individual themselves.
Only under the circumstances where it is claimed, one, that they are employed, and two, that they could be paying the sums and are failing to do so. That's actually where we are. And they have failed to meet what's been agreed on 2 successive payments. That's actually, let me leave it there. Question has been asked. If we move on to the low income, low asset scheme, which we are proposing to replace with the minimum assets process, I think actually the Minister has already answered most of the questions which were raised in the committee. Clearly, the restrictions on LELA are not adequate. People seem to have been trying to get into it when it's inappropriate. I get the impression that a sum that means only 75% of those currently trying to get into LELA may well be in the right place, and I think the Minister is to be commended for doing that. Could I then just briefly address the issues of the changes that have been brought so that the courts no longer have to consider something and they go to the accountancy in bankruptcy, the accountant in bankruptcy rather. Clearly, reducing the load on our courts is a good thing, full stop. It does reduce the total costs left, right and centre. I would expect sheriffs and lawyers not to think that was a good idea, and in their shoes I would say the same thing. I think what I would just want to ask is that everybody, as we get through stage 2, reflects on where the balance might sensibly lie. If there is a genuine conflict of interest, then of course it might be appropriate and probably would be appropriate to go to the court. If you have to value contingent debts, then it might very well be that the courts are the better placed to do that. Or I would suggest there might be other people who are well placed to value contingent debts as well. It might not just be the courts. So I think what I conclude by suggesting, Presiding Officer, is a little bit more thought may need to be given to some of the details of this. Clearly it's heading in the right direction, but I do commend them to give a little bit more thought as to how some people finish up in these positions. Thank you.
Many thanks. I now call Hanzala Malik to be followed by Christian Allard, and I understand that we do have some time in hand to compensate for interventions.
Thank you very much and good afternoon, Presiding Officer. I'm honoured to be given the opportunity to speak on the Bankruptcy and Debt Advice Bill. This bill needs to strike a fine balance. On one side, the balance between helping people in financial difficulty managing their money, and on the other side, to help creditors get their money owed to them. And we recognize that. On the issue of mandatory money advice, I feel that this might be a good idea in theory, as it will make advice compulsory before entering into any form of debt solution. However, I have doubts about the practical application, as the free advice sector is shrinking and does not have the resources to deal with the increased demand. A shortage of qualified advice may cause delay in people accessing proper advice solutions or lead to people taking poor advice. I suggest money advice should not be compulsory for first-time applicants. There is other complications in the bill that I don't agree with. Even the theory. One major stumbling block is Clause 4 of the bill. The proposed debtor contribution order, which will require the debtors to make payments to his or her creditor over a period of 4 years rather than the current 3-year period, is, I believe, unhelpful. No one, and I repeat, no one during the evidence session gave any explanation why it should be increased. However, there was a lot of opposition, and the chance for the whole range of organizations supported the fact that we should retain the current 3-year period. So much so that Money Advice Scotland went on to say that it doesn't make sense in this economic sense to increase the period of bankruptcy from 3 years to 4 years. So there was evidence, and I want to stress, Minister, that when people say that we need proof, we need evidence, well, as an elected representative, I may get 3 to 4 people who come for bankruptcy advice to me in a month. But these people who are working on the coal face are getting 3 to 4 people a day. I can't imagine anybody more expert than them. And they take on the responsibility, and they understand the responsibility, and they understand the people's wish. They understand the difficulty vulnerable people go through. They see the hardship firsthand, and when they say 3 years is appropriate, I take that seriously. I don't wash it offhand. I don't understand. Yes, of course, Mr.
Minister.
I understand the point I'm making, but what I don't understand is why Mr Malik, if he thinks that 4 years is wrong, why he supported 4 years for the other type of insolvency, namely protected trust deeds, when they came before him. Why did you support 4 years for one type of insolvency, but not for another process of insolvency?
Handala Malik.
Well, all I can say to the Minister is that when I listened to the evidence at committee, and when I listened to the evidence from the experts who explained to me the difference 1 year would make to a family, that made sense to me. That made me understand the real plight of vulnerable people in our society. And whilst he and I are fortunate that we do not face those difficulties, those hardships, those sleepless nights, those children going without, they do, because they face that day in, day out. And when they explain it to me, I understand and I listen and I take on board what they're saying. And I wish the Minister will also do the same. An open letter has been released highlighting the deep concerns those are working on the coalface who are saying that this bill is unhelpful. There are a number of signatories who have suggested that this is not right. Money Advice from across Scotland, led by Glasgow Govan Law Centre, have said so. These are the people who are working in the field day in, day out. And I have to say, I have to take that on board. I have to recognize the voice of the people who are concerned and who are going through the hardship. No point in representing people if you're not going to take on board the needs of our community. And finally, I feel that reducing the bankruptcy fee from 200 to 100 is going in the right direction. But I genuinely feel that some people can't even afford that. So perhaps we can look at that fee in a way of doing away with it altogether. Because I think there are still people out there who can't even afford that. And because they can't afford that, they won't go in for voluntary bankruptcy. And as a result of that, it means that they get more hardship. I am not convinced that the bill is balanced in the way that it ought to be. I am not convinced that this bill is going to represent those in our community who need this support and help. And I am pleading for them that we consider this seriously, we take on board their concerns, and we look forward to representing their needs by looking at flexibility and honouring people. And in terms of the threshold that you've increased from 10,000 to 17,000, it's a good one. You may want to index link that, which means you don't need to amend the bill later. But all I'll say is that the 4-year is just unfair and unreasonable. Thank you.
Thank you, Mr Malik. I'm sorry that your speech was interrupted by a mobile device. Can I remind all members that such devices are allowed in the chamber for purposes of delivering speeches and nothing else, and ask members to check that they are on silent if they are using them for that purpose. I call Christian Allard, to be followed by Margaret McDougall.
Thank you, Presiding Officer. Listening to Jenny Mara earlier on, I was reminded of a quote attributed to US President George W. Bush. The problem with the French is that they don't have a word for entrepreneur. It seems, Presiding Officer, that the problem with Scottish Labour is that they don't know the meaning of the French word entrepreneur. I must explain, first of all, that I only joined the Economy, Energy and Tourism Committee recently. John McAlpine, who spoke before me as a substitute member of the committee, would have attended more meetings than I have. I was delighted to hear that our committee supported the Bankruptcy-and-Debt-Advice bill at stage 1. I'm particularly impressed with the wide support from stakeholders that the Scottish Government has received on the bill. This bill is needed, and I too welcome it. Like many other single working parents many years ago, I experienced a level of personal debt that at the time I found difficult to manage. I made sure to keep all my creditors informed of my financial situation and send them regular updates. The reason was simple. Presiding Officer, in my work, I manage a seafood export business. I spend a lot of my time chasing slow payers in order to avoid bad debts. I saw both sides of the problem. So does the Scottish Government, and I congratulate its balanced and responsible approach to improve debt management mechanism, respecting both the right of the creditor and the right of the individual caught in a spiral of debt. Irresponsible banking has brought many countries to a level of debts that governments are struggling to cope with. The same banks have been pushing businesses into factoring arrangements that only protected the bank, failing the struggling businesses and the creditors who end up paying for another form of irresponsible lending. Banks who pushed their customers to take on more loans in the UK did it because of the competition out there. We all have seen the TV adverts, and we all answered unsolicited phone calls telling us how simple and easy it is to borrow money, whatever your financial situation. I'm delighted that the Minister came to Aberdeen to launch the 12 days of Debtmas with one of the organisations responding to this level of unsolicited loans. In the region I represent, North East of Scotland, there are a number of organisations providing help to those struggling with debt. In Aberdeenshire, Gordon Rural Action covers the town of Ellen, Huntly and Inverurie, and the substantial rural heartlands. The Money Advice Service aims to help people gain control of their financial affairs and to help them achieve the best possible outcome. As well as a number of advice centres, home visits can also be arranged for those who are less able to travel. In 2012 and 2013, Gordon Rural Action dealt with 14,718 issues. They are currently handling over £13 million of debt on behalf of their money advice clients and use the Citizen Advice Scotland advice system. In Dundee, Dundee City Council Welfare Rights give advice about debts and help in various ways for people who own money and are having problems paying it back. They won't make any judgment about why people who came to them are in debt. Their job is to help sort out the problem, regardless of how the debt arose. We also conduct outreach clinics across Dundee. Citizen Advice Scotland also providing valuable advice and support for those in debts, with bureaus in a number of locations across the North East, including one in my hometown of Westhill. Their website also provides useful information on how to stay out of debt of the Christmas period. And that's a valid point. Westhill has got 0.6% unemployment, a very rich town, and I'm very proud to live in such a fantastic town. Has got problem of debts as well. It's received the same amount of unsolicited phone calls than we are in the rest of Scotland. I wish to recognise the progress made here in Scotland in tackling the level of personal insolvencies with more debtors opting for the debt arrangement schemes. The Scottish Government efforts and actions to raise awareness of the scheme have brought this possible outcome, a decrease of more than 10% compared to last year, and despite the current financial climate in the UK, how much more can we do? The culture of payday loans has to be challenged, and we across the chamber should make it very clear that a cap on payday loans must come sooner rather than later. As we heard from the Minister earlier on, the Minister has called on the UK Government to put the cap in place as early as April 2014. The Better Together coalition political parties are invited to make a positive contribution to discourage irresponsible credit before the referendum in September 2014. Failing to act, Westminster is sending a strong message to the people living in Scotland. Only with the powers of independence can we bring payday lending under control. Page 400 of the White Paper, in response to question 74, I read, with independence, the Scottish Government will be able to act on issues that are particular concern for Scottish consumers, such as payday lending and nuisance calls. For example, this government will introduce a cap on short-term interest rates similar to those in place in many countries in Europe, Japan, Canada and some US states. The current Scottish Government plans to regulate the advertising of payday lenders and place restrictions on the rolling over of loans. The White Paper, A Vision for Scotland's Future, is not only a guide to an independent Scotland, but it is also and will be a great Christmas present, debt-free.
Thank you. Call Margaret McDougall, to be followed by John Wilson.
Thank you. Well, I certainly hope I don't get it in my Christmas stocking, and I'm sure I won't. Thank you, Presiding Officer, for allowing me to take part in this debate. As a member of the Economy and Energy and Tourism Committee, I certainly look forward to taking part in the debate today. The bill is designed to ensure that people of Scotland have access to fair and just processes of debt advice, debt relief and debt management. As it currently stands, the bill does not go far enough to protect those in debt and could be seen to favour the creditors, which is why I believe there needs to be amendments at stage 2 before I could consider supporting this bill. Presiding Officer, there is much I could talk about around this bill, like including access to bank accounts for bankrupts, and I'm glad to hear the Minister has written to ask for advice on this matter. On the provision of money advice and how it would be resourced, I did hear the Minister say that it was anticipated that around 500 more people would be looking for money advice. But money advice agencies are already under a great deal of pressure, and I think there needs to be some sort of further resource put in there to assist them give that money advice. We also need very well.
Minister.
I think the point to bear in mind is that this bill will make it compulsory, mandatory for people to take advice before entering into sequestration. The evidence shows that 92% of those people who enter into sequestration already receive that advice. And therefore, I was anxious to establish that it's only a relatively small number of people who are not presently receiving advice, and therefore the additional burden resultant from the requirement to make advice mandatory will be proportionate and relatively manageable.
Margaret McDougall, now reimburse your time.
Thank you. Relatively manageable does not mean that they will have the resources to do it. We need clarification in the bill on what is meant by financial education, because we heard evidence around that, and what exactly would it mean? You know, we've heard, would it be at school time? Would it be as part of the entering into the debt arrangement? And also, someone spoke about it could be computerised, it would be electronic, and I think we already heard from Mr Fraser on that may throw up difficulties for some people in Scotland, particularly rural areas with slow broadband. And whilst welcoming the common financial tool, it would be better to have it included in the face of the bill to allow for future proofing, and so it can't be changed without full scrutiny, as stated by Citizens' Advice Scotland. However, I would like to develop my argument around the extension from 36 to 48 months for debt repayments and the proposals for minimal asset process, which will replace the low-income, low-asset process. On the proposal to increase the debtor payment period to 48 months from the current 36 months, I would argue that this change is ill-advised, and instead of offering debt relief, it would extend the period of hardship. It doesn't mean more time to pay. It means another 12 months of payments for creditors and another 12 months of struggle for those in debt, and increases the likelihood of defaulting on the arrangement. This change would mean Scots have to pay back more to creditors than in any other part of the UK. The majority of respondents in the consultation felt it was not required. And this view is supported by a wide range of organisations throughout Scotland, such as Step Change, Money Advice Scotland, Glasgow Central Citizens' Advice Bureaus and Govan Law Centre. And I heard what the Minister said on what happens in England. But, as my colleague Kezia Dugdale said, this is not comparing apples with oranges, and I think Ms Dugdale did give a very clear explanation on the difference. I've already taken an intervention. I don't know if I have time. I ask the Minister if the proposed change if he will reconsider on that 36 to 48 months change and at stage 2. Moving on to the minimal asset process, or MAP as it will be known, which will replace the low income, low asset process within the bill. The fee level of £100 maximum will still be prohibitive for many, as we have heard in evidence in the committee and we've heard many times in the chamber today, even though this is an improvement on the misguided increase to £200 for the Leela, which Labour and Citizens Advice Scotland did not support at that time. Citizens Advice Scotland said that having a fee in place will lead to some debtors struggling to afford it, as it is very difficult to save up any sort of money when you are in debt. While I understand that the accountant in bankruptcy is to be self-financing, I would like to see changes made to the bill whereby this fee could be waived. I believe that the accountancy in bankruptcy should have the powers to introduce a full exemption for those individuals who meet certain criteria around the ability to pay. Ideally, there should be no fee, but if the fee is to remain in place, then I believe fee waiver would give some way to removing the barriers for those who genuinely cannot afford the £100 fee, because let's remember, MAP is for people on benefits or with no assets, and the interest is increasing on their debts while they try to save up that £100 or thereabouts. I also have concerns with the proposal to set the maximum debt level for MAP at £10,000 compared with no limit on the Leela. And I'm pleased that the Minister has reconsidered this and will raise it to £17,000, because I heard no valid reason for this proposal, given that Step Change estimates the average debt level of their clients in 2012 was around £14,500, which means 50% of their clients wouldn't have been eligible for MAP. In addition, the Accountancy and Bankruptcy's own data showed that almost 65% of current Leela clients would not be eligible.
You must draw to a conclusion now, please.
Carrington Dean Group, who offer financial advice, stated that the figure is too low and should be more in line with the average level of their debts, of the debts of low-income, low-asset, which is around £17,000, which I'm very pleased that the Minister has taken that on board. Thank you.
Many thanks. I now call John Wilson to be followed by Alison Johnston.
Thank you, Presiding Officer. I welcome this Stage 1 debate on Bankruptcy and Debt Advice Scotland Bill. Every member will have their own experience dealing with constituents having debt problems, whether that be in terms of maintaining their home or paying bills, and of course having suffered financially the present financial situation, or as a result of a relationship breakdown, for example. The proposed bill builds on the establishment of existing statutory debt solutions and on the previous legislation. It is worth observing that the trend with reference to one of the statutory debt solutions, namely the debt arrangement scheme, has been a growing one. In many ways, this reflects the increasing demand, with the debtors increasingly taking up this option, and we've seen an increase from 2005 to 2012. On many fronts, the debt arrangement scheme are becoming a common feature of society. We have all probably heard the radio adverts and even seen the television adverts as well. No doubt this has contributed to the decrease by 14.7% in personal insolvencies. Many people would like to pay what they owe, but the situation gets ahead of them. It would be no surprise that a lot of people, that those who fall into debt are not always the type of people who our normal prejudices would suggest. I know people who can run the finances of firms and their work extremely well. But when it comes to personal finance, that's another matter and can be a bit of a blind spot. There is no doubt that as a result of recent tough economic times, people who once could service and manage debt are finding it increasingly more difficult to do so. In many respects, we are dealing with a society changing over the years and experiencing structural changes, although it is important to recognise that the Scottish Government approach on this matter, the Government is attempting to tackle these matters head-on. I am reassured that at the heart of the bill is a desire to provide for compulsory money advice and the requirement for financial education. Support like this is invaluable for those who find themselves floundering in a sea of financial troubles. Nigel Donn made reference to the fact that financial education is a requirement for a modern Scotland if we are to progress as a nation. I also support Nigel Donn that the description of the bill under discussion as the Financial Health Service by the Scottish Government should be considered a very apt one. The trend for credit card companies to consistently take minimum payments from customers creates a situation that means the overall debt will take significantly longer to reduce. The home-owning democracy and credit boom promoted in Scotland since the 1980s has come at a price, especially so in times of financial downturn. As I stated earlier, debt levels have increased, and this can be attributed to rising demands, whether it be the finance agreements or energy costs, but real wages have not increased correspondingly in recent times. In many instances, there has been real concern that the process involved in bankruptcy have been unnecessarily bureaucratic, and whilst those in the know will have a good idea how to protect themselves, the ordinary debtor can be at the loss and may not always know who to turn to. As I stated, we all have knowledge of constituents who frankly are at their wits' end and have resorted to ignoring phone calls or not opening mail when debts have been passed to enforcement companies. Being confronted by correspondence from enforcement companies, or as one of my Labour colleagues mentioned earlier, phone calls to employers, can be very intimidating, particularly for vulnerable people, which can lead to further health and social problems. Lenders need to be aware of the demands coming from the wider community, who in turn actually own many of these financial institutions as taxpayers, and those same institutions want action to pursue their debt. The Stage 1 report quite rightly invites the prospect of both the UK and the Scottish Government having discussions with the financial sector on contributions being increased from the industry for debt advice. Importantly, the Economy, Energy and Tourism Committee supported the idea that in its Stage 1 report of completeness across debt solutions. This is an important principle. People in debt are not stupid, but they need to make informed decisions. They need to find the right solution which tackles the debt management issue should be enshrined in legislation. In terms of capacity issues for money advisors and those who offer advice to people, then it is important that minimum standards are maintained for the consumer. I am reassured that the intention of the bill is to support people in paying their debts, whilst recognising the events that lead to financial difficulty. A balance has to be struck that protects creditors and with respect to debtor acquiring additional assets, with a procedure put in place to make it easier for the case to be reopened. Equally, the bill has received broad support from practitioners such as Money Advice and from ABCUL. I welcome the Minister's commitment to the issue, and it is worth highlighting that in relation to the accountant in bankruptcy, this body expects to be able to meet the associated costs associated from within its existing budgets. I would ask at this point, Presiding Officer, for the Labour members to reconsider their opposition to this Stage 1 bill and use the opportunity through the amendment stage at Stage 2 to bring forward amendments that they feel would be relevant to the progress of this bill. I welcome the Stage 1 debate and the broad principles contained in the proposed bill and look forward to the bill making the necessary progress through the Parliament and affords the necessary protection to those genuinely trying to tackle debt issues. Thank you.
Many thanks. I now call Alison Johnston to be followed by Marco Biaggi.
Thank you, Presiding Officer. I too would like to thank the committee's dedicated team of clerks and our adviser and those witnesses who contributed evidence. I welcome the fact that the Government, that Parliament is giving attention to bankruptcy law. Bankruptcy is one of those things in life you hope you'll never experience or need, but it's important to get it right for those who do end up needing help to get back on their feet and to fairly sort out who can and should be paid. A quick search of bankruptcy history reveals it wasn't always this way. The practice of debt slaves in ancient Greece saw wives, children and servants forced into debt slavery to pay for the husband's debts. Genghis Khan's laws apparently included the death penalty if you went bankrupt 3 times. So I'm glad we now see bankruptcy as a financial health service, a way to reform and reorder people's finances to allow individuals, businesses and the economy to move on without unnecessary punishment. Yet there are some things in this bill that I would like to see changed, and I'll come on to that in a moment. Debt and consumer debt has become a larger and larger part of our lives. The policy memo does recognise that. Payday lenders, for example, largely on the periphery of most people's lives until the financial crisis, have seen massive growth and now offer eye-watering rates on the high street and TV. And if we don't tackle this, I fear our new bankruptcy legislation will be accessed by more and more people in Scotland. People's access to bank accounts while they're undischarged from bankruptcy was an issue raised in evidence. There is no point in a financial health service if people can't hold a bank account to help them carry out normal everyday chores like paying bills. The Minister has indicated he is working on what can be done, and I look forward to revisiting the bank account issue at Stage 2. I raised the issue of the increase in the debtor contribution period from 36 to 48 months with the Minister after the evidence we heard in committee was that a broad spectrum of organisations were against the move. And the Minister said he would continue to look closely at all those issues during the bill process. And I hope, following today's debate on this issue, that we can continue to do so and that we find a position where the risk of payment breakages is reduced. Citizens Advice Scotland made it clear in their briefing for today's debate that they think the current balance of 3 years is the right one for creditors and debtors. Failure of payment helps no one, and I hope the Minister will comment in his closing speech on Citizen Advice Scotland's advice and on other organisations' position that this period should stay, because their expert comment should not be lightly dismissed. I'm also concerned about the proposals to remove automatic discharge. The Minister suggested he will look further at this issue. The Law Society told us in committee that the introduction of automatic discharge by the 1985 Act was seen as a huge step forward that would stop people ending up in bankruptcy in perpetuity. ICAS believed automatic discharge should be retained to minimise the bureaucracy involved. The Economy, Energy and Tourism Committee shares these concerns. We accepted the principle that discharge should be linked to the debtor's cooperation, but aren't persuaded by the case for the ending of automatic discharge as proposed in the bill. We heard that measures already exist to deal with uncooperative debtors. Debtors can be retained under restrictions of bankruptcy for 2 to 15 years by a court bankruptcy restriction order. And discharge can also be deferred past the normal sequestration period if that will benefit the creditor. These appear to be sensible existing measures to address uncooperative debtors, and I would need to hear arguments about how they are not working before being convinced of the current proposals. The Law Society made it clear that the existing system is effective, and the proposals as they stand are unnecessarily complicated. Citizens Advice Scotland raised concerns in committee and in briefings for today that the need for a 6-point declaration from the trustee before discharge is unnecessary bureaucracy and will add to trustee fees. And, as we've heard, there is also concern over how the cooperation of debtors will be interpreted, and insufficient detail on that is available, as far as I can see, and the committee has requested some clarity from the government. As I said, the Minister addressed this in his opening speech. I would be grateful if he could confirm that he agrees that the case for removing automatic discharge as proposed in the bill has not been made. I look forward to him addressing the concerns raised by members in the Chamber this afternoon. I am minded to support the policy aims of the bill at stage 1, but I certainly believe that there are amendments required at stage 2. Thank you.
Many thanks. And finally, in the open debate, I call Marco Biaggi.
Thank you, Presiding Officer. This was a very long process on the Economy Committee, and during that I, for one, was particularly grateful for the help we got from the clerks, from Spice in particular, excellent advisor Nicholas Greer. I think for most of us before election, our only experience with bankruptcy was playing Monopoly, and the wisdom that they were able to impart certainly helped with our deliberations. It was also our advisor, I must say, perhaps unwisely for him, that first referred to the bill by a word derived from its acronym, BADAS. I looked up the definition of that acronym on urbandictionary.com and definitely constituted unparliamentary language, so I won't repeat it here, but I can report that it is a compliment of a sort. The bill changes a very important part of Scots law, dating back, as the policy memorandum helpfully highlights, to the Bankruptcy Act of 1621. Since that bill, as an act, endured for 364 years before being repealed, we can only hope that this bill can reach a similar level of timeless appeal. But this is the right time to be reopening this area of law. Citizens Advice Scotland report their bureau in 2012-13 took on 15,800 debt cases with a total debt of over £186 million. Changes to bankruptcy law and the debt relief model therefore have the potential to have a significant positive impact on the advice and support available to these clients. I'm sure we've all seen it in our surgeries. And when the government consulted, 129 responses were received, 3 times the typical number for bankruptcy consultations. The government has already updated the debt arrangement scheme system, as Kezia Dugdale had highlighted, the system short of bankruptcy that freezes interest and charges and prevents further legal recovery in exchange for a full repayment plan. With better access under the changes to money advisors, the number of people able to access DAS has been increasing significantly. And in the last Parliament, the Homeowner and Debtor Protection Act, introduced in 2009, was a very rapid response to the recession, passing a limited but quite valuable set of amendments to help protect homeowners and debtors, in particular to reduce the risk of homelessness as a result of insolvency. But today we're debating the Bankruptcy-and-Debt-Advice Scotland Bill. And I was going to talk about the Chinese walls and the accountancy and accounting and bankruptcy that I'd been asking about in the committee process, but I have been impressed by a demonstration of parliamentary pirouetting worthy of a Commonwealth gold. It really began with a government being accused of flip-flopping by a party that had just promised to vote against in the chamber what they had earlier voted for in committee. I remember the Bain principle when it reared its ugly head, this desire to vote against anything suggested by the Scottish Government or the SNP, and to find some reason, however tenuous, to cling to. Is this what is inflating what should be a stage 2 objection of detail and drafting into a stage 1 objection to the general principles? Because it's certainly not an approach that is shared by other parties that have concerns about the detail. Or perhaps it is that the Labour Party simply didn't notice and choked on their cornflakes this morning when they read an article by Govan Law Centre in the Herald.
Jenny Mara.
Presiding Officer, when I read the bill, and it is the principles of this bill that we cannot agree with because it is regressive. And as Mike Daly points out, it's taking us back 30 years. I said in my opening speech that it is about the principles of an inclusive economy, and that is why we can't agree with the principles of this bill.
Marco Biaggi.
when I read Mike Daly's article, I saw that his argument was against one particular section, which he wishes to see changed. That is an approach that could be pursued at stage 2. And the Minister has drawn attention to the IVA. When he did that, there were screams of apples and oranges. Apples and oranges actually have a lot in common, certainly more than, apples and Challenger tanks or whatever. But in this case, because both IVAs and DCOs are statutorily regulated methods out of uncontrollable debt, I would just suggest that they have a little bit more in common even than that. The IVA takes 5 years, and its most direct Scottish equivalent, the protected trust deed, might I remind the Labour Party, also takes only 4. But there are other differences, and neither DCOs nor IVA's PTDs can be reduced just to their duration. And yes, this is the PTD that, when it was increased to 4 years, wasn't opposed by the Labour Party. And let's also remember that bankruptcy is one of just 3 routes, and one we don't want to see many people taking. And since 2008-9, the rate of DAS has been very sharply increasing and bankruptcy falling, largely as a result of those changes. I would commend the graph in the SPICE briefing, page 8, which illustrates it very well. If this was the US Congress, I might have a big whiteboard with it, but perhaps we've already stretched the permissiveness of the presiding officers with regard to technology in the chamber too far today. And as I said at the outset, this is a very, very timely bill. Last week, Parliament had a special visitor, Santa, who came and told us that the payday lenders had been naughty this year. Tonight, we'll debate 12 days of Debtmas. And I think we have to remember that we have to avoid a situation where an unsecured loan becomes for life, not just for Christmas. I'm here all week. And I remind people as well that in welcoming this bill, in its principles, the Association of British Credit Unions stated it could deliver a debt advice, debt management and debt relief service fit for the modern era and fairer to creditors and debtors alike. We may have differences over the detail, we certainly do, but out of 293 paragraphs there were divisions at only 3. So if you vote against this bill in its entirety, you're voting against money advice and education, standardising what is expected of debtors, removing clarity and consistency, the minimal asset processes, more flexible income requirement and shorter discharge, a freeze on enforcement being expanded beyond DAS, simplification of the functions into the AIB, and the possibility of payment breaks for undischarged bankrupts. So I would just urge everyone in the chamber, perhaps more in hope than expectation, to unite and endorse the general principles of this bill tonight at its stage 1 vote. Thank you.
Many thanks. We now turn to the closing speeches, and I call on Mary Scanlon with up to 7 minutes, please.
Thank you, Deputy Presiding Officer. Can I just say that I can see the Minister is very seriously in his comfort zone today, having been a previous legal specialist in the area of debt and bankruptcy. And at the outset, can I just say I will refrain from picking on any arguments with the Minister, particularly on legal and technical aspects of this bill. But by recent comparisons, I think this stage 1 debate has been fairly consensual. And I would also like, as others have done, to thank and to commend the committee for their excellent work on what certainly appears to me, as an onlooker to the committee, to be a fairly complex piece of legislation. The report contains many recommendations, with several divisions between the members. Obviously, I always look to see how the divisions end up, and I was quite surprised with our convener, Murdo Fraser, and the SNP voting together against Labour and Greens at paragraphs 41 and 44. And I just felt that this was so unusual that it was probably worth a mention. Whilst we certainly support this bill, we also support the gist of the recommendations made by the committee for further information, for more clarity. And I would have to say at this stage that is absolutely perfectly normal for a stage 1 report. That is what it's all about. That's what the committee is here for, and that's what we are here for. So I welcome the clarity and the further information on several issues given by the Minister today. However, when I did read the committee report, 77 pages of it, and then I printed out the government response, I actually thought the printer had broken down when it only printed out 2¼ pages of a government response, which I now understand only refers to one section of the bill. I think this is unusual, particularly given the complexity of the bill, but as I said, I do commend the further information brought forward today. I think there are some serious concerns that we have to respect from the Law Society. Their response to the Stage 1 Committee report does set out significant concerns relating to 16 sections of the bill, which indicates the scale of the task for the committee at Stage 2. And I can appreciate the concerns of the Law Society, given the shift from the courts to the Bankruptcy Office. It is indeed a bold move to remove the safeguard of judicial involvement in areas where the legal rights of the debtor and creditors are directly affected. Sections 36 to 40 are described by the Law Society, rightly or wrongly, as unnecessary, cumbersome and a lengthy appeal process. Other issues they raise relate to conflict of interest, access to sequestration, a lack of clarity in many areas, and the failure to deal with the debtor's home, which the Law Society state as frequently the most problematic issue in personal bankruptcy. And I have no doubt that further information will come forward after this stage. But the underlying goal must be that the Bankruptcy-and-Debt-Advice Scotland Bill has to be an improvement on what is in place at the present time. It's only right and proper that people have access to fair and just processes of debt advice, debt relief and debt management. And I'm pleased to say that we wholeheartedly agree with the Minister that those who can pay their debts should pay their debts. As Mike McKenzie mentioned, creditors should get, and Joan McAlpine and others, creditors should get the best return possible by balancing the rights and needs of those in debt with the rights and needs of creditors in business. Paragraphs 40 to 46 relate to the minimum assets process and LILA, as is now being called. This has the potential for an individual to be free of bankruptcy within 6 months, which I think should be welcome, with a more streamlined procedure. And I do trust that the concerns raised by the committee and several speakers today will again be addressed at Stage 2. On mandatory money advice, with money advice available for one debt solution and not another, there is a clear need for a consistent approach. The requirement for debtors to obtain mandatory money advice from an approved money advisor prior to entering bankruptcy is reasonable, whether or not they wish to take that advice, but it is a reasonable option. The hope would be that the provision of mandatory advice would increase the opportunity for the right debt solutions being offered to suit the unique circumstances of the individual. My next 3 paragraphs had to be scored out, given that the Minister announced £200,000 for ring-fenced funding, and I share Murdo Fraser's point in asking if it will be recurrent, and I'm sure he could address that in summing up. A 6 to 8% increase in cases for citizens' advice and others would undoubtedly require additional funding, not to mention training. And the committee has rightly sought clarity on the increased workload for money advice, as well as monitoring the advice, the quality of the advice and the performance of money advisors. And given my age, I can cast myself back to my past life as a volunteer with citizens' advice. And, you know, we all had some debt cases. And to ensure continuity, one person dealt with one debtor and met regularly. And several times you would find that the debtor would choose to spend money on other things rather than repay the debt. And many of the cases continued for several years. This was over 20 years ago, and significant progress has been made in that time, including the debt arrangement scheme, with the success stated by the Minister. But there's no denying this issue is complex, it's sensitive, and it does require professional training and handling. So I fully support, I support the bill. I don't say I fully support it. There's a bit more work to be done. But I do wish the committee all success in their future deliberations on this bill, which is critical to the lives of so many individuals and families in Scotland.
Many thanks, and I now call on Jenny Mara with up to 9 minutes.
Thank you, Presiding Officer. I would not agree entirely with Mary Scanlon. It's been a consensual debate, but I do agree it's been a very good-humoured debate on what I think is a very important topic. I would like to turn firstly, in summing up, to Clause 4, if you will allow me, Minister. You may not believe, but I have been in political debates on Clause 4 before, many years ago, but not as pernicious, I think, as the Clause 4 that is before us today, because we have disagreed this afternoon on the amount of people who gave evidence, who agreed with your recommendation to take the repayment period from 3 to 4 years. Minister, I would like to clarify that more people who responded said they would like to leave it the same at 3 years. And the figures you quoted earlier, the 32 respondents who said 5 years as opposed to the 27 respondents who said 3 years, these were the respondents who actually agreed with the period being extended. 75% of respondents disagreed with the period with the period being extended. So I think you've been slightly disingenuous with your interpretation of the figures in this table, because it is clear from the evidence, and this is the Accountant in Bankruptcy's analysis of the consultation, that 75% of respondents actually disagreed with that extension that you propose in Clause 4 of your bill.
Ms Mara, could you address your remarks through the Chair, please, rather than directly to the front
Sorry,
bench?
Presiding Officer. But perhaps we can come back to that when the Minister closes. On the point I made earlier on the Minister's policy memorandum, it is the case that in the policy memorandum for this bill, the Government's own policy memorandum, they draw attention to the fact that our courts are under increasing pressure from civil and criminal business. And this is one of the justifications in the Scottish Government's own policy memorandum on this bill to transfer business from courts to the accountant in bankruptcy. And given the fact that the Scottish Government are pursuing court closures across this country, I think the Government need to stand up today and say whether actually these court closures are having an effect, because the transfer of the business to the accountant in bankruptcy leaves us with serious concerns. And if these concerns as a result of Government cuts and closures to courts, then I think that is something that the Government needs to address. Because the roles and responsibilities of the accountant in bankruptcy, it used to be in receipt of government funding, but Fergus Ewing reformed it, saying it had to be self-funded and should do so within the ethos of full cost recovery. But now this bill gives the accountant in bankruptcy substantial quasi-judicial functions. Now this is ridden with potential conflicts of interest. And what's more important in the situation and circumstances of the debtor or the accountant in bankruptcy's bottom line. Now, the accountant in bankruptcy could become judge, jury and executioner, and this leaves us feeling very uncomfortable. And if this situation has arisen as a result of court closures across this country instigated by the Justice Secretary, then I think the Scottish Government need to face up to that in their closing remarks today. If I can turn to some other points that were made during the debate. Nigel Donn raised, and I don't know if it was perhaps a passing remark, but certainly a concerning remark regarding wages, creditors taking money directly from people's wages and directly from the employees. I think that is particularly worrying. I'm hoping, yes.
Joan McAlpine.
The member is probably too young to remember the anti-poll tax campaign, but I was a proud member of the no pay aspect of the campaign, and my wages were arrested by a Labour council. Would she, I know that she was too young to be around at that time, but would she like to comment on that rather shameful aspect of our party's history?
Jenny Mara.
As I say, the member is going back many, many years. We're not in favour of anyone's wages being arrested, neither now or in the past. And I would hope that no amendments will be forthcoming at stage 2 that reflect these remarks.
I'm seriously wondering if I heard the member correctly. Is the member saying it is the policy of the Labour Party not to support earnings arrestments for creditors in any circumstances?
Jenny Mara.
Not directly from employers, I would tell the member. Now, the case for removing automatic discharge was made very eloquently by Alison Johnson, and I would ask the Minister to reflect on that as well. I come back to a point that Marco Biaggi...
Order, please. Members should not be speaking to each other across the chamber. Ms Mara.
...raised earlier about the principles of this bill. As I said in my opening remarks, we need to make sure that as many people are participating in our economy as possible. This bill does not facilitate that. And now is not the time to ask ourselves how to get the most from those who have the least. In our post-recession economy, where wages have stagnated, food prices and fuel bills continue to soar, now is the time to ask how we empower, include and extend the hand of the state to those who need it most. That is the test that we must apply to this bill, and that is the test I think that this government has failed at stage 1, and I hope that we will see a much improved bill at stage 2. Thank you.
I now call on Fergus Ewing to wind up the debate. Minister, you have until 4:59 to do so, and therefore I would suggest there is time for interventions.
Well, thank you, Presiding Officer. I do have rather a lot to say, so I'm quite confident I'll be able to fill the time available to me and much more were it available to me. And there was a time, as Mary Scanlon kindly alluded, when I did know a bit about bankruptcy law. I was, for some reason, accredited as a specialist in insolvency law by the Law Society for many years. And I once made the mistake of pointing that out in Kilmarnock Sheriff Court to the great Sheriff David Smith, who is still with us, although not on the bench. And he, at that point, said, "Ah, Mr. Ewing, an expert." At that point, I knew I'd made a big mistake. So I am not an expert in bankruptcy law, but I do know enough to know that the detail, the technical detail, is extremely important, and it's complex, as Mary Scanlon rightly said, and it is essential in bankruptcy law to master the detail and make the very best efforts to ensure that we get it right. And the risks are very serious, and these risks were manifested back in the 1985 Act, when, I think, without any malign intention, it so happened that there was a gross underestimate by the Law Commission of the number of people whose bankruptcies ended up being paid for by the public purse and carried out by insolvency petitioners. The bill rose to over £20 million a year, and as a result of that, Michael Forsyth brought forward the 1993 Bankruptcy Scotland Act, and he was generous enough to give me some credit for campaigning at that time on that, together with Tom Shields of the Herald newspaper. And the point I'm making, Presiding Officer, is that was because it was an unintended consequence. No one ever intended that it would cost £20 million to the taxpayer to process bankruptcies of people who had no assets and very often modest debts. In some cases, the debts were less than the fees. It was ridiculous. But it was amended. But the point is, we have to study the detail. We have to master the detail. And I would say that to all members who are participating in this debate. I wanted first just to answer a specific point that both Mr Fraser and Ms Scanlon asked me to respond to, namely the provision for £200,000 in respect of the education responsibilities and how we compiled that figure. This was done after considering representations at a meeting that I held fairly recently from the advice sector, the Money Advice Scotland, the CAB, local authorities. We had this meeting in order to discuss the details of the bill and to ascertain what changes they felt, technical changes and others, should be made, and generally how it would operate in providing a financial NHS in Scotland and providing that education function. And essentially this is a one-off payment. It's not an annual payment, and it's a one-off payment because we recognise that to prepare themselves and the money advice sector and the individuals that will be required to implement it, to provide that advice. There will be the initial requirement to prepare things like modules, instruction manuals, and also to give help, assistance, information and guidance to those who will have to discharge these new functions. Now, a reasonable estimate of the sums involved are £200,000, and that will be allocated to Money Advice Scotland, and it will be monitored by the AIB. Secondly, there have been questions by many members about the level of fees for the process. And let me say that the Accountant in Bankruptcy has indicated her view at committee, and plainly we want to make sure that we keep fees to a minimum. But I was pleased to hear Mike Mackenzie pay tribute to the work that the Accountant in Bankruptcy does. And when he says that, of course, he means her staff, who actually do the work under her leadership and with the excellent support of the senior staff, many of whom are at the back of the chamber today. They do a terrific job. They carry out these processes to a very high degree of professionalism. I've had the opportunity to meet with the staff and discuss their views about how bankruptcy law should be changed. And I will always remember, in speaking to the staff at Kilwinning at the Accountant in Bankruptcy's office, what one thing would you like to see changed about how we handle debt in Scotland? And it was better education, especially of young people. And I think in the long term, Presiding Officer, the vision of a financial NHS must be one which encompasses and encapsulates parents, teachers, schools, debt advisors, and people in business and in the voluntary sector, all playing a part to make sure that we live in a society where we inculcate, explain and get across good financial management to children at an early age, and we do that in order to counteract what has become the malign scourge of payday loans, a form of venal usury, which few of us my age could have contemplated when we were at university. It would be a feature of the system in Scotland. I'll give way to Mr Fraser.
I'm grateful to the Minister for giving way and providing clarity on the £200,000 sum. But as I now understand, this is to fund a financial education package, which is clear and is welcome. Can he say if the Scottish Government are planning to do anything to assist the money advice sector, who told us in evidence they were looking at a 6 to 8% increase in cases as a result of this legislation? Will they be getting any additional resource?
Minister.
Well, we have carefully worked with the CAB, and we have an analysis which I have here somewhere, which I will send to the member, which estimates their current debt caseload, and the figure from memory is around 15,000. Our estimate of the per annum debt cases per annum. That could be wrong, but I'll correct it if that is so. My understanding, therefore, is that the additional burden will be of the order of 3, 4, 5%. But we will look carefully at those figures. We want to continue to work very closely with the CAB, as we have always done, because, as has been said, I think by Mr Malik, their officers work at the coal face. And I was pleased recently to meet Nairn CAB members when they work with Nairn County are being sponsored and they are advertising their services in a football club in Scotland, as opposed to some of the payday lenders who have bought out advertising rights in rather more successful football clubs, perhaps, than Nairn County. In any event, if I could turn to the principles of the bill, Presiding Officer, the bill aims to ensure that appropriate, proportionate debt management and debt relief mechanisms are available to the people of Scotland, which are fit for the 21st century. And as many members have said, I think Mr Don, that there is a balance to be struck between the interests of the creditor and the debtor. That really hasn't changed since Gowdy's textbook or Meston or the 85 Act or more recent legislation. There must be a balance struck between the creditor and the debtor. There must be a framework which provides for debt management, that is, people to pay their debts, but also for those who are simply unable to make payment of their debts, debt relief. And the debt relief mechanisms in Scotland are twofold: protected trust deeds and sequestration. And this bill deals with sequestration, and the proposals contained have broadly been welcomed, I think, by most of the respondees, including the Citizens Advice Bureau, incidentally. And in doing so, the first thing to say is that the debt arrangement scheme has been an enormous success story in Scotland. We have gone from a few hundred, I think just over 400 cases when it was first introduced per annum to over 4,000 cases. Now, that's an increase of tenfold. 10 times as many people now use the debt arrangement scheme as did when it was first introduced. And we were grateful when it was first introduced by a previous executive before we became the Scottish Government in 2007. But since then, we have made a number of changes to it, Presiding Officer. We have introduced payment breaks. We have frozen interest and charges. And now we have backdated the application of the freezing of charges to an earlier time to avoid additional misery. So we have made it more and more effective. More and more people are using it. And the interesting thing about debt arrangement is that most of the people, in fact, the overwhelming majority of people who enter into the debt arrangement scheme in this country continue to pay their debts, and to pay them almost in full, 90%. I think that tells a good story about the people of Scotland, that they want, in large, to pay their debts. And therefore, we do not want to do things in the law which would introduce a lack of consistency and transparency and discourage people from entering into the debt arrangement scheme. Now, the fact is that the average period within which people pay their debts in a DAS scheme is, I'm told, around 6.5 years. If we make the period where those who can pay only have to pay for 3 years, then they're only paying for 1/2 of the period that those who wish to pay their debts off in full are, in general terms, on average, required to pay. That is, if you like, creating the possibility of an unintended consequence, that some people who are able to pay their debts off in full instead choose to opt for the debt relief solution, because it means that they will pay, well, hang on a second, they will have to pay only for a very, very much shorter period. That's why I introduced the story of unintended consequences, Presiding Officer, at the beginning, because we have to be very, very careful that we don't do that. I think it was Mr Malik.
Hansel Malik.
Thank you very much, Minister, for that intervention. I don't think anybody is suggesting that if people can pay, should not pay. I think the suggestion that is being made is people who cannot pay, who are vulnerable, who need our support, who need a leg up to start afresh. It is for those people we are saying don't change the rule, the law.
Minister.
Well, the fact is, and I do find it strange that this doesn't seem to have been grasped because it's set out in the bill, those who are on benefits pay zero. Those who are in modest earnings may well pay zero. Those who are most vulnerable will pay zero. We are not talking about those people who are most vulnerable here, by and large, because they are required to pay zero, and indeed we clarified this. This government clarified this in the recent trust deed regulations. We are talking about a relatively small proportion of people who pay a contribution across bankruptcy, namely 1/3 of all bankruptcy cases are cases where there is a contribution paid. So it's totally wrong. It's simply a misunderstanding, I'm afraid, of the process to suggest that what we are doing is going to result in those who can't pay having to pay. That simply is a false assertion, I'm afraid. I think Marco Biagi really hit the nail on the head in his contribution. I won't repeat his remarks, but I did think that they had a certain force, because it is extremely difficult to understand why the chief opposition party supported this bill at committee and now appears, because they have concerns with a few of the sections, to be opposed to a bill which is supported by the vast majority of the money advice sector, including the CAB. Yes, we can have debates, Presiding Officer, at stage 2 about the detail of the bill. That is what stage 2 is for. But it does seem to me very disappointing indeed that the Labour Party is choosing, instead of supporting all the good measures that Mr Biagi read out that are in this bill, to be adopting. Well, I think we've really exchanged a lot of views, and I've already got on record all the answers to the questions that she repeated in her closing remarks. Incidentally, I would say that the arrestment of earnings process can only be carried out, as far as I know, against an employer, and it has been part of the law of Scotland during all the periods in which the Labour Liberal Party were in power. Had they wanted to scrap arrestment of earnings as a diligence in Scotland, they had ample time to do so. I'm not sure if it's their policy now, and neither, after Jenny Mara's contribution this afternoon, is anyone else. I wanted to turn to the functions of the Sheriff and the AIB, because these are serious matters, and in response to Nigel Don's remarks, we will, of course, consider this extremely seriously. However, it was wrong to suggest, as Jenny Mara seemed to do in her closing speech, that this is a process which is begun in this bill. That is untrue. It is factually incorrect. The process was begun a long time ago, and it was hastened by the 2007 bill, when many processes were referred to the accountant of bankruptcy, which hitherto had been carried out in the court. At one point, you had to go to the Court of Session to recall sequestration, a ludicrous amount of expense to private or public funds. It is absolutely sensible that relatively routine matters are carried out with the accountant of bankruptcy. It provides greater consistency, clarity.
If you could begin
it is supported by the Scottish Courts administration. And the AIB is most certainly not judge, jury or executioner, to use Jenny Mara's phrase. We do not have executions in Scotland the last time I looked. But we are in favour of the effective transfer of process in Scotland. The requirement of advice was supported by 93 out of 129 respondents, so I was disappointed Mr Malik is opposed to it and is with the majority that thinks people shouldn't get that advice. Presiding officer, the main issue here today, in closing, relates to the question of what contribution debtors should pay by way of a contribution. It is the view of the Scottish Government that we are striking the right balance, that the proposals we have set out are designed to make sure that the creditor gets a reasonable turn, the debtor is treated fairly, there is provision for payment breaks, there is provision for variations, people's changing circumstances can be taken into account, and people in Scotland, once this bill becomes law, I think will be in receipt of a system of managing debt in Scotland which is second to none.
Thank you. That concludes the debate on stage 1 of the Bankruptcy-and-Debt-Advice Scotland Bill. The next item of business is consideration of motion number 8515 in the name of John Swinney on the financial resolution for the Bankruptcy-and-Debt-Advice Scotland Bill. Colin Fergus-Ewing to move the motion in the name of John Swinney.
Formally moved.
Question on this motion will be put at decision time. The next item of business is consideration of business motion 8630 in the name of Joe Fitzpatrick on behalf of the Parliamentary Bureau setting out a business programme. Any member who wishes to speak against the motion should press the request to speak button now. And I call on Joe Fitzpatrick to move motion number 8630.
Moved.
No members asked to speak against the motion. Therefore, I will now put the question to the Chamber. The question is that motion number 8630 in the name of Joe Fitzpatrick be agreed to. Are we all agreed? Yes. The motion is therefore agreed to. The next item of business is consideration of business motion 8631 in the name of Joe Fitzpatrick on behalf of the Parliamentary Bureau setting out a stage 1 timetable for the Housing Scotland Bill. Any member who wishes to speak against the motion should press the request to speak button now. And I call on Joe Fitzpatrick to move motion number 8631.
Moved.
No member has asked to speak against the motion. Therefore, I will now put the question to the Chamber. The question is that motion number 8631 in the name of Joe Fitzpatrick be agreed to. Are we all agreed? Yes. The motion is therefore agreed to. The next item of business is consideration of 2 Parliamentary Bureau motions. I would ask Joe Fitzpatrick to move motion numbers 8632 and 8633 on approval of SSIs.
Moved on block.
The question on these motions will be put at decision time, to which we now come. There are 4 questions to be put as a result of today's business. The first question is that motion number 8610 in the name of Fergus Ewing on the Bankruptcy-and-Debt-Advice Scotland Bill be agreed to. Are we all agreed? Yes. The Parliament is not agreed. We move to a vote. Members should cast their votes now. The result of the vote on motion number 8610 in the name of Fergus Ewing is as follows. Yes, 73. No, 33. There were no abstentions. The motion is therefore agreed to. The next question at motion number 8515 in the name of John Swinney on the financial resolution for the Bankruptcy-and-Debt-Advice Scotland Bill be agreed to. Are we all agreed? Yes. The Parliament is not agreed. Therefore, we move to a vote. Members should cast their votes now. The result of the vote on motion number 8515 in the name of John Swinney is as follows. Yes, 73. No, 0. There were 33 abstentions. The motion is therefore agreed to. The next question is that motion number 8632 in the name of Joe Fitzpatrick, order on approval of an SSI be agreed to. Are we all agreed? Yes. Are we all agreed? Yes. The motion is therefore agreed to. The next question is that motion number 8633 in the name of Joe Fitzpatrick on approval of an SSI be agreed to. Are we all agreed? Yes. The motion is therefore agreed to. That concludes decision time. We now move to members' business. Members who leave the chamber should do so quickly and quietly.